All right, yield nerds, what an exciting time to be in the markets today. We just had our first interest rate cut in several years, and I thought this would be the perfect time to talk about valuations, specifically the secret sauce of Warren Buffett's mentor, Mr. Benjamin. And we'll talk more about what that is. The ratio that is used is called the CAPE ratio or the PE10 ratio. And I'll tell you all about it and why it matters more than ever today. Here I am using the cape ratio, wearing a cape. I happen to have three hands, but hey, that's just minor detail. All right. Well, we are just about 2 years from launch, and we're at about 370 something subscribers. Thank you for your support. If you're new, please remember to use the income investing roadmap, which comes from a beginner level of a fixed income investor all the way up to today. Most importantly, please know that I do not have any magical powers. I have been wrong. I will be wrong. Make sure you check anything you hear here on your own. Well, there are four parts to this episode. First, we'll go see how the market is doing, and then we'll talk about the CAPE ratio or the PE10 ratio in detail, and then see how the stock market is doing if you were to apply the CAPE ratio as a lens, and then I'll share my trades with you. Well, some of you who have seen my portfolio for a while know that I am a steady Eddie. The blue line is my portfolio. The brown line has a bunch of slightly more aggressive bonds. I don't do that. And so I'm kind of going along in a straight line. I sleep very easily. I don't stress out in the market up and down. And all of these returns are after market. Do not adjust your screens. I am beating the NASDAQ in the last 3 months. Those of you who stayed in the NASDAQ heavily saw your fortunes go up and down and sideways. And, I slept through all of that. So let's talk about why that is. And the main reason is because even though I am rapidly increasing my equity allocation is still a meager 2% of my portfolio. I am largely in fixed income, trying to wait and see when I should enter the equity market in the right way. And having said that, even within the equity allocation, I am fantastically out of balance. I have a whole lot more in consumer staples, healthcare, and materials, and I have nothing, as in zero, in IT. And I will get there, and I'm going to do it at a time of my choosing. Maybe the CAPE ratio will teach me when to get in and what to buy. So my asset allocation, even within fixed income, is very heavily towards treasuries, and within that, very heavily towards short-term treasuries. So as you can imagine, the change in interest rates affects my income a lot. And so I'm sharing how I think about it. I do have some corporate bonds, which are mostly longer term. So for the most part, I have a short amount, couple of percentage that I've allocated to really long-term corporate bonds, but most of it I keep in the short term because I do expect a yield event later this year, and that is just my expectation. Having said that, let's go to the crux of the matter. Let's see if we can, use a lens that the great Mr. Buffett used, his mentors used, and Ben Graham used, and see what that is telling us. It is called the CAPE ratio, and I am wearing a cape and getting ready to invest. Before I move further, I again want to reiterate what I'm about to share is not investment advice. It is not tax advice. I am not a wealth management advisor, and I don't do politics or pitching products. Well, hey, almost forgot. Before we go further, I'm going to take a very quick detour and do a rapid yield Super Bowl after the rate change. You may remember we started in May 2023, kind of at the green line, and we shot up in yields across the board because the Fed kept increasing interest rates. But look at that, that just looks awesome. We came crashing and burning to the blue line after the latest interest rate interest rate decrease in the short term. But watch that. The long end of the tail is actually going up. That is called bear steepening, meaning people still don't want to hold the long end. If you don't want to buy the 10-year, that means demand is lower, and which means price falls. When price falls, yields go up. So think very carefully before adding duration too much on the treasuries. That is what this is saying. The other people are not doing that. Okay, so where do you put your money? From what I can see, this is Yield Super Bowl. If you don't know what that means, you should watch prior episodes. The best place to park your money in the short term is treasuries. Believe it or not, bank CDs work very well in the 1 year. And then agency bonds, which are getting called left, right, and center, have a command of the situation. And then the long end are corporate bonds, which is why I have my allocation for corporate bonds. So having done the yield Super Bowl after the interest rate cut and noticing the bear steepening, I'm going to go on to the CAPE ratio. Here is what Buffett and his mentor noticed. If you only looked at the PE ratio, they saw these massive spikes right as recession started. And they said, wait a second, why is there a spike in the PE ratio when a recession starts? It makes no sense to me. And then they realize, you know what? The PE ratio, after all, is the price over the earnings. When there is a recession or the immediate aftermath of a recession, earnings fall off a cliff. When earnings fall off a cliff and prices do not fall right away, PE ratios spike. When PE ratios spike, it was 126% during the great financial crisis. Absolutely incredible. So when PE ratios spike, this is the great crash of 1929. And you can see how 9/11 did, and you can see COVID. So everything showed that same pattern. Only looking at the PE ratio is a fallacy because PE ratios tend to go up when earnings go down. And so they said that is not a good metric because I can't invest just based on a PE ratio. I need something better. And so the great Mr. Ben Graham said, buy not on optimism, but on arithmetic. And he also said, by the way, the arithmetic you should use is not pure PE ratio. And so he and Robert Shiller came up with this new ratio that they conveniently named the Shiller ratio, or the CAPE ratio, which is the cyclically adjusted price to earnings ratio. What is that? What they said is, look, if an egg cost 10 cents, 20 years ago, and an egg costs 75 cents today, then a merchant who sells eggs can make $1 today by selling 1¼ eggs, but they had to sell 10 eggs to make that same money. You can't take the earnings of that merchant and compare today's earnings versus the earnings from 10 years ago. You need to inflation adjust the earnings. What a beautiful concept. What CAPE ratio does is it inflation adjusts earnings so you can get a better picture of the PE ratio. And since it is done over 10 years, it's called the PE 10. And so the PE 10 should be the gold standard. And as a way of testing it, they applied it to PE ratios across time. And instead of showing these wild swings, you can see how even within the decile, it beautifully fits into a very nice bucket. And they said, well, the fifth decile, meaning companies whose PE ratios are 80% and higher, we're not going to buy them because they are overvalued. We are okay with buying the one immediately below the fifth decile, or in true Warren Buffett style, we'll buy the ones 2 deciles below. Those are the undervalued stock. That's what we want to do. Hint, hint, nothing is undervalued today, but hey, that's just details. And so the Shiller ratio has been incredible in identifying when to buy and what to buy. And so then we say, okay, let's apply the Shiller ratio to today's stocks and see what happens. Ready? Let's see. If you take the PE 10 ratios and organize them month by month, the PE 10 ratios for each month in general started from as low as 5 to something as astronomical as 45. And the 1929 PE ratio, PE 10 ratio, peaked right there and it fell. The great financial crisis PE 10 ratio peaked right there and fell. We are here. In other words, the PE 10 ratio, even inflation adjusted, people are willing to pay more for $1 of revenue today than one day before the 1929 market crash and one day before the great financial crisis. It is beyond nuts. So let's see what that means. You know what I think? I think in aggregate, the PE-10 ratio says that we are overpriced. But I bet you if you looked at variability, maybe it's closely packed and we should be able to cherry pick it out. I think we should find a nice nugget here. Here is what this says. If you take the PE-10 ratio and zoom, yes, you are an idiot if you bought the extremely overpriced stocks, and 20% of them were extremely overpriced right before 9/11, and the same happened in 1929. So let's see how we look now, and I'm guessing we're not bad at all. Oops, slight problem. The large chunk of the market is still heavily overpriced. As we came out of COVID, PE ratios, even the PE-10 ratios did not settle because inflation was so high that inflation-adjusted earnings still were out of whack. Even as inflation is coming down now, somehow we are still okay with paying historically high prices for a single dollar of earnings. So the argument here would say that in aggregate, the stock market is overvalued to the point where we are at the 90th percentile of overvaluing. This is a very busy chart, and let me tell you what this says. Each dot is a month. It's a month and its PE-10 ratio. And on the x-axis is inflation. When you have extremely high inflation, PE ratios fall because companies can't borrow, they can't make money, they're having trouble selling. When you have extremely low inflation, that's a deflationary economy, they have the same problem. So we're going to focus on this middle purple band, inflation between 2.5% to 4%, kind of normal, if you will. And as you can see, a lot of the months flow there. And the great bull market, which is the red dot between January 2008 and February 20, fell right in that area. And when COVID came, and this is the COVID pandemic, this little Australia-shaped thing here, all those months, what they showed when COVID came, all of a sudden, we initially had some crisis, but we kind of dug out of it and said, I am willing to pay more per dollar of earnings. And guess where we are? Today, we are in this little yellow dot, which is the current PE ratio, even post-COVID. We are at the highest of the high, meaning somehow we have justified paying a lot of money for a single dollar of earnings. And that is the moral of the story. Then you have to say, how can anybody justify paying so much for a single dollar of earnings? And the answer is, that's because of the pipe dream of future earnings. The 12-month forward PE ratio means the expectation. This isn't reality. This is the expectation of future money that is going to be made. The expectation is again sky high. Somehow we all sit here and pretend as though I can pay a lot for the stock because they are just going to keep on making money. That is the expectation that is being conveyed. You do you. So I said, you know what, I'm going to be a smarter investor. I'm going to see if I can create, or if there is already a fund that only tracks the CAPE ratio, and I can then pick the middle of the band of the CAPE ratio stocks and say that's what I'm going to do. Lucky for me, and to be clear, I have no conflict of interest. I did not invest in this fund, and I never was an investor in this fund. I found a Shiller enhanced CAPE fund. It mostly puts its money into fixed income and has a large chunk that only invests in companies whose CAPE ratio is in the middle quartile. And so you sit there and say, that is it. How did that do? And you see how it did. It returned 12% on average every year over 10 years, 11%, and just this month it's returning 3%. Amazing. And I thought, this is it. I should just park all of my money on this because clearly this is the best thing since sliced bread. And I had a little bit of a shock humble pie there being served. Instead of investing in just the CAPE ratio, if I had put all my money on the S&P 500, I would beat the CAPE ratio every single time in these measured time periods. What is that telling me? It's telling me I can do all the arithmetic, but the laws of gravity are being defied in the market because the S&P 500 is beating any and all arithmetic. The moral of the story I take from there is the performance of the S&P and the Nasdaq have nothing to do with fundamentals. They are beating fundamentals to pulp. It either means we have the wrong fundamentals, we shouldn't even be measuring inflation adjusted earnings. We should just say what is the future earning potential and believe that the experts predicting future earnings potential are always right, or we are heavily overvalued. You do you. I will tell you what I did in a moment. Here are my trades and my next steps. My fixed income portfolio is evaporating. Most of my agency bonds are getting called. I still have a very good allocation, but 2, 3 of them are getting called a week. I continue to invest only in the very, very short-term treasuries because I'm expecting an yield event at the end of the year. But I am buying equities. I'm going from 0.4 to 2% as you saw, but the equities I buy are all concentrated in food, pharma, gold, and military, meaning things that you theoretically cannot live without, or in the case of gold, it is an inflation hedge. So what do I mean by that? I own a gold miner, I own a couple of pharma companies, robotic surgery also in healthcare, food companies, military companies. You do you. I am sticking to my knitting here. I have a short allocation, small allocation to equity. I am betting on more inflation returning, unfortunately, and I also am going to wait until the end of the year before increasing my equity allocation dramatically. Thank you for watching Yield Nerd. Please do your own research.